Alright, so in this video I'm going to show you how to build 60/40 ETF portfolios. We're going to go through 5 different portfolios and they're all pretty easy to build, but 4 are especially easy, so anyone with $1 million can leave their financial advisor. So I'm going to show you how to withdraw money as well with that $1 million you saved up with. Alright, so let's jump into Testfolio. Let's just see exactly how these portfolios performed. So what I'm showing you here, I'm going to put links to everything, links to the website to show you exactly the funds I'm using. Make it really easy for everyone. So this is showing you what $1 million looks like invested in November of 2008, what it grew to till around today. So basically, if you put $1 million in over 15 years, that grew to over $3 million in every case. And the top 10 portfolio, this is using 10 different ETFs, so there's no bias. You can spread your money all around every market, and that grew to 4.5 million. So all these portfolios grow. This is 60/40, and this is getting almost 10%. So just an amazing portfolio. I'm going to show you exactly how to build it right now. So these portfolios, I gave them all names just so they're easy to follow along. This is a BlackRock one-fits-all 60/40 product. Easy. This 2-fund portfolio, it's just using equities and fixed income. You're using IOO. This is the top 100 global equities. And AGG, this is an American aggregate bond. And now the 3-fund portfolio, you might be familiar with this, but these ETFs I'm showing you today are older because we've got to look really far back. So this is PXF, this is going to take care of our international, SPYs our S&P 500, and AGG again. Now here's a 3-bucket portfolio, maybe a little safer. Basically you're just putting global equities again, you're putting 30% in an aggregate bond and 10% in T-bills, like your money market, just so everything's safe in case there's a crazy downturn like we saw recently. And your top 10 portfolio, basically we're using an emerging market, we're using an international ETF. We're using some kind of sector ETF. This is a tech ETF. We're going to use a small cap or a mid cap. This is the small cap value ETF. This is the S&P 500 again. Here's an old emerging market bond. Here's an old corporate bond. Here's an old tip. We're going to use gold for our commodity and bill again for our T-bills. So that's exactly how you build all these portfolios, and basically what you're trying to do is get really good Sharpe ratios and have uncorrelated assets. Basically this gives you like the perfect portfolio. You're just looking for low volatility and high returns. How do we make the most amount of money with the least amount of risk? So hopefully, those first 4 portfolios are pretty easy to build. And there's nothing wrong with around 8%. The 3-bucket portfolio is the safest. So if you need that cash, yes, it barely or almost hit 8%, but barely lost to most of the other portfolios. And your bogle heads, like your 3-fund portfolio, perform just fine. But I'd use 10. I like using 10 ETFs. That should be enough for every portfolio, even if you have $1 billion. So now what we're going to do is take money out of the portfolio. So we're going to take out $50,000 a year. Basically, this is a 5% withdrawal rate. So taking a look at the portfolios now, we're still ahead. We still have money pulling out. Now there's one downside with this software. Basically, it doesn't do a very good inflation adjustment. Basically, as you get older, you should be taking little by little by little, a little more out every single year. You got to adjust for inflation. All right, so now we're going to try something a little crazier and pull out a 7% withdrawal stream just because this doesn't adjust for inflation too well. So there is an adjust for inflation button. Let's just click it and I'll show you kind of what it does. Basically, it's not pulling out the amount for inflation, it's giving you what your money is in today's dollars. So I just don't really like how it does that calculation. It'd be nicer if it just showed you like, hey, I'm taking out 50 grand this year, 51,000 the next year, that kind of thing. But it just doesn't. So anyways, let's get rid of that and try a 7% withdrawal stream. like this is high. Basically, you're going to want to use retirement planning software to show, okay, here's my performance, here's how much is in each account, how much do I pull out every month or every year. But all you have to do is look at your money once a year with these simple portfolios and pull your money out once a year. So again, all these portfolios, like you're basically still more than your ending value. So what we're going to do is look a little further back. I'm going to get rid of most of these portfolios and we're just going to look at a 2-fund portfolio. This is so we can look further back. So here we can see all the way back to 2003 and doing a 7% withdrawal stream. Basically, this is hitting the '08 crash. You can kind of see, whoa, that's a little scary. Maybe not. You still have 650,000. But basically, after 15 years with a 7% withdrawal stream, you still have around 600 grand. Like there it is right there. You have a compound annual growth rate of 6.86%, so not too bad. Let's bring this down to something a little more realistic again at a 5% withdrawal stream. And you still have more than what you started with after the giant '08 crash. So in my opinion, the best way to withdraw your money is a dynamic withdrawal stream. Basically base it on inflation, but mostly on your investment performance. If your long-term performance is doing well, take a little more out. Like basically you're just going to leave more money to the taxman if you leave money in your accounts. So to give more money to your kids or have a better lifestyle in your retirement, definitely use a dynamic withdrawal stream and you'll be a-okay. So hopefully you learned a lot today. Basically, again, I'll put everything on my website so you can see the exact portfolios and some old ETFs. I'll also put some of the popular ETFs you're used to so you can kind of match the portfolios together a little easier. All right, take care.